So Fed rate hikes, they don't necessarily mean the markets won't go up.
Yeah. Well, for us, Brian, great to be with you. Happy St. Patty's Day. I wore my St. Patty's tie for you today. First time I put on a tie in a few months, but that's to be with the Sullivan Show this morning. As far as the markets and the Fed rate hikes, that's right. I mean, historically, the first rate hike does not kill the bull market. It tends to inject volatility in the markets. But to a point you made earlier, this normally happens when the economy is growing. I will say there's some differences with this rate hike and where we are with Fed policy that we have to, be aware of as far as how big the balance sheet is. As you look at what's interesting, I'll give you one more RBI, Brian. Right now, as far as the first rate hike, historically, the unemployment rate has been around 6%. And inflation has been around 2.5% when the Fed first raises rates. This time, as we know today, the unemployment rate is much lower, below 4%, and inflation is above 7%. So the Fed really has to move forward, and that's why they focused so much on that yesterday, even in light of the geopolitical tensions that we still have.
Yeah, that is fascinating. And of course, that Putin's war does add a whole new variable and potential risk and volatility to all the historical references, Keith, I would imagine. I mean, it's a big, you go back through history and you say, okay, this happened, but then this happened. We also have a $9 trillion Fed balance sheet and a war started by a madman in lower Europe.
Yeah, I think there's no doubt. You use that as a starting point, but I think it was Warren Buffett that said if all you needed was history, the richest people would be librarians, right? But it's a good starting point to say this is what tends to happen, and then you layer on other things around that. Listen, I think right now, from our perspective, the range of potential outcomes is unusually wide, especially what's happening with the commodities markets in general and what's happening overseas. We still think the underlying trend is positive over the next 12 months, but we're certainly expecting more moderate gains in this volatility to stay, which was going to happen even outside of the invasion. If you think about it, Brian, the market actually peaked in early January around the Fed minutes.
Truly remarkable, Keith. So give us a little advice. It's Opportunity Thursday, we'll call it. Happy St. Patrick's Day. Thanks for the tie. We're the only ones wearing one, by the way, probably the whole day. What do we own right now, Keith?
Yeah, well, listen, I think from a big picture asset allocation perspective, we are still overweight equities relative to fixed income, but at a lower margin than we would have been last year. Over the last 2 years when we've been big bulls, we're still positive at bringing that in a little bit. We still like the U.S. on a relative basis overall. And then within the U.S., small caps are trading below 14 times earnings on a forward basis, so a lot of bad news priced in.